This video covers material in Chapter 10, which is entitled from your textbook, Forwards and Futures, Hedging and Target Strategies. And as you can see right off the bat, I've eliminated the forward part of this chapter. We don't really need to deal with forwards, and it just makes it a far more simpler discussion to just talk about everything in terms of a context of futures contracts. Remember, the real difference between a futures and forward contracts as they pertain to hedging is the mark-to-market and the variation margin that goes along with futures contracts that are present in forward contracts. Other than that, operationally and mechanically, the ability of a forward or a futures contract to hedge a spot instrument they're pretty much identical. So we can avoid a lot of confusion, just get rid of, as you can see, get rid of the forward component. Let's just talk about futures contracts in this chapter. Now, the first thing we want to do is give you an outline of where I'm going with this. This is the first of, I'm guessing about 3 videos. And what I'm saying is, look, this component right here, I'll talk about a general introduction to the concept of hedging. And then what I'll do is I'm going to present a bond primer. In other words, I'm going to do a refresher on bonds, because what I want to do after that is I want to cover bond hedging and targeting strategies where we target a level of risk. And then I want to do stock index hedging. Okay? But before I get into bonds, I find that, bond hedging, I find that students are, kind of soft in understanding bonds and the actual underlying bond risks. And that's important to know. What are the actual underlying bond risks? Because we're going to put together hedges with futures contracts that are designed to get rid of those risks. We should know, have a good handle on what those risks are and how they operate. So, we're looking at a general video here, and then we're looking at a short bond primer, and then we're looking at a third video that'll cover bond hedging and stock index hedging. I think this is a really informative chapter, and that it will, it's going to get at the heart of how to hedge various spot risks. And we're going to try to abstract it away from much of the detail as possible. I shouldn't say as possible, as much as the detail as I can, to get right at the heart of the issues. If you read the chapter, there's a lot of material in there, and I'm going to try to cut to the chase on what we need to know to develop futures hedging and target strategies. So the first thing we want to do is get a handle on basis again. We saw basis earlier, and basis is defined in your text as being the spot price minus futures price. That difference between the two. And so why does that come up here? Well, it's important to understand because we're talking about hedging. And when we hedge, we usually try to hedge the spot price. We try to get rid of spot price risk. What do I mean by spot price risk? Well, for example, the price of gold going up or down dramatically, we want to offset that spot price risk that we have. Okay? Now, it turns out that if we hedge, if we put on a hedge and we lift the hedge before the futures contracts expire, it turns out that we end up taking what's called basis risk, meaning that we've substituted and got rid of spot risk and we take on basis risk if we lift the hedge early. And I'll give you examples of how that operates and how that works in a few minutes. But the other interesting aspect of basis is basis risk doesn't generally exist, usually does not exist if you hold the futures contract to expiration. So therefore, this concept of basis is important to understand hedging. Because like I said, if you're hedging an underlying position, if you lift the position early before the futures contract mature, you're you're eliminating or reducing, let's just say you're reducing spot risk substantially, and you're taking on basis risk. If you hold the futures contracts until expiration, then what happens is you won't have basis risk anymore. And so that's important to understand. So what actually happens and why is that? Well, one of the reasons that you have differences between when you lift the hedge early and when you keep the hedge on till expiration, it all has to do with convergence. Okay? And convergence is, look, it says basically the futures price at expiration equals the spot price at expiration. When that holds, then you won't have basis risk. And this only holds when you hold a contract to expiration, because that's when we're at capital T here, at time period capital T. So keep this in mind, and I'm going to bring it up again. And in fact, I'm going to show you in a minute, because we now need to go and look at the profits from hedging. And it's basically it's somewhat accounting, but it's also very financy in the sense that you're going to intuitively understand and learn what it is to have a hedge on a spot, and how to break up the profits and account for the two components to a hedge. So I'm on page 2 of the notes, and I'm on the section now on profits from hedging. And so first off, let's define, as the textbook does, a short hedge profit. And a short hedge profit, pi will stand for profit. Okay? And the short hedge profit, here's how it's defined. It's going to be the spot minus the spot today minus the spot when we put on a position. Okay? And this represents the capital gain or loss on the spot. So this is a position, this is a long position. Right? You should be able to see that that's a long position, because if you put on a spot when this is, say, 10 cents a pound and this spot goes to 20 cents a pound, you just made 10 cents a pound from holding that inventory, whatever the inventory is. Now we're looking at a short hedge profit. So normally when you're not hedging at all, this is how people make profits, businesses make profits. They get this gain in their underlying spot. But now we're talking about short hedging. And the way the textbook defines it is the short hedge, it refers to the futures position. And I got to be clear here. I want to make sure I'm clear. When the textbook talks about a short hedge, it's not only referring to the short position, and the short part is referring to the futures position, right? But when it talks about the hedge, it's not only the futures position, but it's the underlying spot that your textbook is referring to here. And the point that I'm trying to make here is that other authors and other researchers in the area of futures contracts will often look at, when they see the term short hedge, they think it's simply referring to the futures position, which is a short position. But your textbook author is saying, look, the short hedge is not only the actual short hedge, but it's the underlying spot that it's trying to hedge. Okay? So what we're saying is the profit or loss is the gain or loss on the spot plus the gain or loss on the futures position is what our profit's going to be. Now a long hedge profit will equal the spot at the time you implement the futures position minus the spot at point time t at a future point in time. So remember, we're basically looking at it. You start off at time 0 when you put on the futures position, and then there's expiration, and then there's time t somewhere in between there. Okay? So this is somehow you're short the spot inventory, okay, for some reason, and then you take a long hedge long, you take a long hedge, which is FT minus F0. So you make a profit, for example, if the futures contract goes up. When the futures price goes up, that implies that the spot is going down. You're going to have a loss here or gain here. And remember, your whole purpose of hedging is not to make a profit. And you got to realize that. That may sound a little funny. Your purpose when you're dealing with hedging is not necessarily to make a profit. It's to try to minimize the variations in your profit. And so the change in your profits will be much smaller as a result of hedging. And that's really what the point of it is. You want to hedge your bets, so to speak. And if you hedge your bets, you're reducing risk. And if you're reducing risk, you know, classic finance, you're reducing risk. You got to reduce your expected return. So now, look what happens with these models. Well, let's assume that time t, like I said, is somewhere in between here, between time 0 when you put the hedge on. So right here, you put the hedge on, and then if you were to unwind the hedge, take the hedge off all the way up through here, you have basis risk. And if you get rid of the hedge, well, you have no choice, but at expiration, the hedge disappears because the futures contract mature. Well, what I was saying earlier is if you unwind the hedge anywhere from here to here, you have basis risk. And if you unwind the hedge, you'll basically let the hedge mature at time t, you have no basis risk. Let me show you what that means, because what I'm going to do is I'm going to invoke that convergence principle I just showed you a minute. So if you hold the futures contract until time t, capital T, then what happens is, recall that ST equals the futures price at time t. Remember convergence? And so let's hammer convergence down. Right before expiration, the futures and the spot should almost be at the same identical value. And if it's not, if the spot price is higher than the futures price, then you use the golden rule: is you short the spot and you buy the futures, let it mature a few minutes later, and make a profit between the two. So arbitrage is going to force these two values to be identical at expiration. And when these two values are identical at expiration, that basically means that you've hit convergence. Your basis is now 0 because your spot and your futures price at capital T are the same. Your basis is 0, which means if your basis is 0, then you have no basis risk. And so what that means for this formula, for example, is that if ST equals FT, let's get rid of that. Let's just simply use this notation. Then what that means is that mathematically these two numbers will offset. Oh, by the way, that should be a T there. These will offset, and your profit will be the futures price that you entered into minus the spot price at the time you entered the futures position. That will be your profit. Okay? That's a lot simpler than working with this formula. So at expiration, if you hold a futures contract at expiration, your profit boils down to this formula. For the long hedge, when these two numbers are equal, because you're at time capital T, then the profit will be the spot price at the time you implement the hedge minus the futures price at the time you started the hedge. That will be your profit for the long hedge. Okay, so it boils down to this, nice and simple, which means there's no basis risk. But if you lift the position early, you lift the hedge early, you're subject to basis risk because you can't apply the convergence principle to the story here. Okay? Now, let's look more carefully at unwinding a hedge before expiration. And let's account for that in terms of basis. So that's the goal here. Let's account for it in terms of basis. So it turns out that the short hedge, a short hedge, if you unwind before expiration, the profit can be written in terms of minus B subscript 0 plus BT, a little t. Notice it's not a capital T because we're unwinding before expiration. Okay, again, before capital T, we're unwinding somewhere here at time little t. And so what it boils down is your profit boils down to basis. This is basis risk. So what you're looking at this way, well, what does that mean? Well, what we're saying is this can be written as the spot minus the futures at time 0 when you put the hedge on. Okay, that's this accounting. And now we're going to look at the basis risk at time little t, and that's ST minus FT. Okay, so if you rearrange this, you end up getting ST minus S, okay, which is the long spot position, plus the short futures position. That's what I just showed you a minute ago, right here in this math. I just showed you that. Well, what I'm saying is, if you rearrange the F and the S at time 0, and you rearrange the F and the S at time t, little t, and you define this right here to be B subscript 0, basis at time 0, and then basis at time little t, you can basically rewrite this profit formula in terms of basis. That's what your textbook is doing, and the reason your textbook is doing it is because it's trying to tell you that if you lift the hedge early, you're subject to basis risk. And the funny thing is, normally what you do when you put on a hedge is normally what you're trying to do is you're trying to get rid of spot risk. You're trying to get rid of the risk of the underlying spot asset. But it turns out that, yeah, you know, you are getting rid of a lot of that spot risk, but you're taking on some basis risk. Now, if you hold the position till expiration, like I said before, you can invoke the convergence principle. You don't have to worry about basis risk, and the math becomes much simpler, as I showed you here with these two formulas. Okay, so now what we want to do is let's look at two types of hedges for the moment. And what I mean by two types of hedges, we're going to look at a perfect hedge, which, you know, kind of happens but kind of doesn't. But we'll define a perfect hedge, at least in theory. And we can get pretty close to a perfect hedge. But it turns out a lot of stuff is when it's hedged, it ends up being a cross hedge. And we'll get to that in a minute. So I wanted to find two types of hedging, perfect hedges and cross hedging, and then relate that up to basis risk. Because you know you kind of do have basis risk in these situations, where you need to at least compare the basis risk that you have in these situations. So a perfect hedge is when you have the spot is identical to the underlying asset of the futures contract. And a really good example would be, look, you know, you hold a pile of an inventory of gold. You're a jewelry maker, say, a manufacturer of jewelry, and you have inventory of, you know, thousands of ounces of gold, and it turns out to be, you know, like 99.95% pure gold, the same quality as the gold that's underlying the futures contracts. So in other words, what we're saying is, look, that underlying gold in the futures contract matches up identically in quality with the gold that you hold in inventory. That's what we're referring to as a perfect hedge, perfect match. But you know, in the real world, perfect hedges are sometimes very hard to come by, especially depending on the type of underlying inventory that you hold. So as I mentioned in the notes on page 3, you could be a cereal maker, some type of cereal that requires and demands #1 yellow corn, which is a very high quality corn with a certain moisture content and so on, according to the specs. But you may not find #1 yellow corn contracts. In other words, futures contracts often have #2 yellow corn as the underlying. Now, there could be substantial differences between the two at various points in time. So what I'm saying is, most of the time, #1 and #2 corn will move perfectly in sync, and you would expect the price of #1 to be higher than the price of #2 because #1 is higher quality. But you would expect that to happen, but it doesn't always look like that. There can be bottlenecks at times in either type of corn. There could be a shortage of #1 relative to #2 or vice versa. It could be because of weather. It could be because it could be another country bought up #1 instead of #2 and vice versa, because corn is traded internationally. And so what can happen is you can have #1 prices, futures prices, gyrating like this, and you could have at times, #2 actually, because of a shortage, going up higher in price than #1 and so on. So you don't have a perfect hedge in there. That is so when you use #1, when you use #2 futures contracts to hedge #1 corn in your spot inventory, you could end up with this. And what does this mean? This is basis risk. In other words, the difference between the futures and the spot price are not in sync with each other. And so the basis is not zero. It's gyrating back and forth. Now, it's probably gyrating back and forth by pennies a bushel. The spot price itself could be moving a lot of money back and forth, but your underlying spot, the difference between these two lines, is much smaller than any individual actual line here. And that's what we mean by when you put on a hedge, you're trying to get rid of spot risk, and you can get rid of a lot of spot risk, but you're going to end up taking basis risk. Now, the point that I'm trying to make is a subtle one here, but it's important to distinguish. You can have basis risk even if you hedge right up to expiration when you have a cross hedge. I'll say it again. You can have basis risk right up at expiration with a cross hedge because there's no guarantee when you lift it at time t. There's no guarantee that these two time series will always line up exactly. One could go above the other at any point in time. One could go below the other. And so the point is, when you have a cross hedge, you've got to form some form of basis risk in there. And you can see that, I think you might even be able to see this even better. For example, let's go a little crazy and say, look, you hold an inventory of gold, but for some reason you don't want to enter in the gold futures contracts. You hedge with silver. It's like, okay, you hedge with silver. Now keep in mind that gold prices and silver, they're probably most of the time highly correlated. But remember, gold is in the thousands of dollars an ounce, and silver is in the tens of dollars. It could be $20, $30, $40 an ounce versus $1,200 an ounce. So you got this huge basis, which it's so big, the basis is so big, it almost doesn't make sense. But the futures price, the silver prices are going to gyrate back and forth by probably pennies, but the spot price, or the futures price for gold is going to change by dollars a day, and this will change by pennies a day. And so you're going to see that there's a giant difference between the two. It almost doesn't make sense in an example like this to compute basis, because the spot and the futures price, your gold versus futures prices of silver, are going to have gigantic differences. that you could think of it conceptually as being a type of basis. Because basis risk is all about the fact that the futures and the spot price don't move in sync with each other. And that is very natural in a cross hedge. So now what we want to do is let's actually look at a perfect hedge and then compute the profits and losses on those perfect hedges. First, we'll look at the profit on a hedge when we lift the hedge early, which means, well, you should know when we lift the hedge early, you should automatically think basis risk. Okay? And so we're going to show basis risk. And then we're going to say, well, what happens if we take the same hedge and we hold it to expiration? What's our profit? And next you're going to find out that, well, there is no basis risk. And the formulas are going to boil down to something very, very simple, like I showed you before, to calculate the profits. Okay, so I'm on page 4 of my notes here, and it says, and this is a really neat example. This is one of the reasons why I like to do this chapter, is because I just don't throw a bunch of futures prices and spot prices and tell you to calculate a profit or loss. That's too dry, too boring. What I like to do is give you a context to the problem. What is the problem at hand? What is the situation and what is the problem? And then compute the profit or loss. So that's what I'm doing here on page 4. It says, suppose that you are a futures trader for a sophisticated electronics manufacturer. You manufacture electronic parts. And you have a steady demand for platinum. Platinum is one of the rarest metals in the world, with approximately 90% of the supply coming from just 2 countries, South Africa and Russia. World demand for platinum tends to be steady. Platinum is an excellent conductor of electricity, extremely resistant to corrosion, and exhibits a high melting point and is quite durable. All the things that you want with for electronic productions, electronic equipment production. The price of platinum, however, is quite volatile, depending on the degree of speculation in markets. Some of the speculation is driven by expansionary monetary policies around the world. In other words, countries that are increasing their money supply, trying to lower interest rates, they increase their money supply, and all that extra money that's floating around in an economy has to go somewhere. Sometimes it creates stock market bubbles. It pushes stock prices up as people try to chase stocks. Sometimes it pushes up real estate prices and causes real estate bubbles. And often it creates what people refer to as commodity price bubbles. And so we're assuming here that that's the situation, that it could be the case that, you know, there's commodity bubbles. And when you have commodity price bubbles, you got a lot of variation and risk in the underlying. Now, let's continue the example. So that's kind of like the the background to this problem. Now, let's get more specific with this firm. Your firm that you work in has an inventory of 1,000 troy ounces of platinum, enough for several years of production. The inventory gets marked to market each quarter, which means your firm's earnings can be unpredictably volatile due to swings in platinum prices. So this is an example of regulations causing volatility in the markets. So you're forced to do mark to market. What it does is you price your inventory, and your inventory is going up and down. That means your net income is going up and down. Investors are looking at your business as like, what the heck is that? I don't want to go near that firm. It's too risky. So what you decide to do is you decide to do some hedging, because if you hedge it with futures contracts, that volatility will go away. The spot price that's in your inventory will go away because the futures prices will offset that. Okay, now let's get back to the actual numbers here. With this backdrop, you decide to hedge the company's platinum risk to stabilize earnings for the rest of the year, starting in August by selling 20 contracts for $1,500 an ounce with an expiration of February. Okay, so it's August now, expiration is February. You're doing 20 contracts. Each contract is 50 ounces, and the spot price is $1,475 an ounce. The basis is $25. So notice how big the spot price is. It's $14.75, and basis is only minus $25. Okay, at the end of December, news arrives that causes you to lift your hedge. And you lift the hedge when the futures price is at 14.50. And the spot price at that time is 14.07. So let's look at the hedge. So let's compute the profit from this hedge, okay, when we lift it early. Okay, so that's the goal here. Let's calculate the profit from lifting the hedge early. And then part B of the question, the second part of the question will be, what happens if you hold things, hold the futures contract till expiration? Okay, so part A, let's look at the profit from holding it, from holding the futures contract until December. In other words, lifting it early. And this is the formula. And that formula, by the way, these formulas, you would think, holy mackerel, these things are ugly. I'll never figure it out. But you know, when I first studied this material, we didn't use these formulas. You can almost cut right to the chase and didn't have to, you can kind of reason your way in and say, look, the profit from this situation is, look, you got a gain or loss on your inventory. Right? That you always have that, even if you don't have the futures position here. This is your gain or loss from your inventory on a per ounce basis. Okay? Now you figure out your profit or loss separately here for the futures contract, and just add the two together. You kind of almost don't need this formula. And if you don't follow and you don't understand what I'm saying, and you just literally put this on your formula sheet for a quiz or an exam, you're just going to be totally confused. It's not even worth putting this on, because you should be able to rationalize your way through it without a formula. But I'm going to apply the formula for two reasons. One, I'm following the textbook, so I'm consistent with that. But it also, it's a framework to try to understand the material. And the point is, as soon as you understand the material, you can kind of discard the formulas. Okay, enough said there. So here's our long inventory, and let's just plug the numbers in from what's given. Well, when you lift the hedge, the spot price was 14.07 in December. When you put the hedge on, it was 14.75. And so let's see what that means before we go any further. That means, when you put the hedge on, it was 14.75 versus 14.07. Your inventory lost $68 in value, okay? Just sitting there in the warehouse, or probably a vault maybe if you have platinum. So you lost $68 in your inventory in and of itself. Now, if you put on a good hedge, most of this spot risk should be eliminated through the futures position. This is what you should be thinking, because if it doesn't, then something's wrong. So now the futures price when you put the hedge on was $1,500, and when you lifted the hedge in December it was $1,450. Well, you made $50 on the futures contract, okay, which offsets most of the loss in your inventory. And so you end up losing $18, which is better than losing $68. Okay? So now notice we did not invoke convergence principle because we didn't wait till time T at capital T at expiration. Lifted it early. Now, what is the source of this risk? The source of this $18 loss here, or I should say risk, well, it's basis risk. The source of the loss is basis risk. Now, how can we prove that? Go to the formula that we just looked at. Profit or loss can be described in terms of basis risk when you lift it early. So let's see that little t there. And the way we write it, let's fill out the numbers. All right, S0, we'll write out the letters, and then we can write out the numbers. Okay, so there's basis at time 0, there's basis at time t. 1475 minus 1500. Okay, this basis at the time was 25. The basis right here at the time we put the position on, and the basis at when we lifted the hedge that basis was, let's see, 1407 minus 1450, and that basis was minus 43, and that's where we lose the $18. In other words, basis changed. It was a positive $25 when we put the hedge on at time 0, but it went to minus 73 in December. And there you got a really nice example of basis risk and accounting for it in this accounting framework that your author provides. Okay? Now, I would argue that this right here above is relatively intuitive, breaking this apart. What's less intuitive is trying to explain this in terms of basis risk. But that's what we just did. That's what this accounting framework will do for us. Now, let's look at part B of the question. And part B means, basically says, we are going to lift the hedge at time t. Okay? And so let me read the question. It says, now suppose instead of lifting the hedge in December, you hold the contracts until expiration when the futures price is 14. You can put a T here if you want. It's 1450. Okay? The futures price is 1450. Compute the profit from the short hedge. Show that there is no basis risk in this situation. So the profit is going to be, formula will be, here's the gain on our spot, our inventory, plus we have a gain or loss on the futures position. Okay? Let's start filling the numbers in. Well, let's see, 1475, we know that number. The futures price when we put the hedge on was 1500. We're given, right here, the futures price was 1450. Right? But wait a second, we don't know what the spot price is at expiration. Or do we? We do know because we're at expiration. We're going to do the convergence principle. We're going to operationalize that. And we know that these two numbers are going to be the same. So this has to be 1450. Well, if that's the case, then we lose 25 on our inventory, but we should make some of it up. And it looks like we're making up even more of it through the futures contracts. And then we get positive $25 for profit. Okay? And so since these two numbers offset, it all boils down, because this is a negative and this is a positive, it all boils down to F0 minus S0 is your profit when you hold till expiration. And let's see, 1500 minus 1475, that's $25 right there. So there you have it, a really nice example using perfect hedging, a concept, the idea of perfect hedging, and looking at basis risk when you lift the hedge early, and then no basis risk using convergence principle if you hold the futures till expiration. Now let's look at the idea of cross-hedging. Things get a little more complicated when you do cross-hedging because there's some slipperiness between the two underlying assets. You got your inventory and you got the underlying to the futures contract. They're probably not moving in sync. And if they're not moving in sync, there might be ways for you to optimize your hedging strategy on this. So right now that doesn't make sense, but it will in a few minutes. Cross-hedging and optimization. Okay. So to start off with the idea of cross-hedging and optimization, let's go back to the perfect hedge that we looked at earlier. When we do a perfect hedge, we're looking at a spot inventory, say, of gold, and then we're hedging it with futures contracts. Now, we hedge on a one-to-one basis. It's almost natural to think that way. That, look, you got 1 ounce of gold sitting in your inventory, then you hedge it with 1 ounce in the futures position. And so that's a 1-to-1 correspondence, and that's what we refer to as a hedge ratio of 1-to-1. Makes perfect sense. Okay? When you do a 1-to-1 ratio in hedge with a cross hedge, it's referred to as a naive hedge, because you need to. You may not be thinking it all the way through. In that, when you have a cross hedge, the spot and the underlying may not be moving perfectly in sync with each other. So that implies that you might need extra number of futures contracts to hedge a position, or you might need, when I say extra, more than one contract, more than one-on-one, or you might need less than one-on-one. You might need less futures contracts than the underlying spot that you hold in your inventory. And so what we're getting at is where things, we want to get at the co-movement or the covariance between the spot and the futures. Because when you have a cross hedge, the two may not, and this is hard to draw, the two may not be working perfectly in sync. Or it could be, here you have your spot price, and then you could have, for example, you could have really, look at the volatility there. You can have really the same correlation, but way less volatility. Let me see if I can draw it here. And I think you can see what I'm trying to do. Is these two wiggly series are highly correlated. Let's assume they're perfectly correlated. But look, one of them is way more volatile, as you can measure by the deviations from their means, as best I can draw it freehand. And so those deviations are way bigger in the upper, the spot price compared to, say, a futures price over time. And if that's the case, then hedging 1-on-1 doesn't make sense in this situation, in this cross hedge. What's going to happen is you're going to, according to this, you're going to need more futures contracts to absorb this excess volatility in terms of the futures contract. Okay? So think about that. You're going to need more than a 1-to-1 ratio. You're going to need more than one, what's called a hedge ratio of greater than 1 to absorb all this extra volatility. And if it was the other way around, where the spot price was very stable and the futures price was very volatile but highly correlated, then you would need less than one futures contract for every one unit of futures versus 1 unit in spot. That's what we're trying to get at, and this is the idea of it's measured in covariance. And if you took investment management, that's helpful, but covariance should have been covered in your statistics class, and it should have been covered in your financial management class. But let me cover it, and let me derive what I'm talking about and show you the importance of how covariance works, and how it's important to not just this class, but all of finance, diversification theory, portfolio theory, evaluating the pricing of stocks and bonds, all has to do with covariance. So this is one of the most fundamental aspects of all of finance. But we're going to apply it here in terms of futures contracts. So here, let me look at this here now. This is what I want to do. Let's take a look. Look, this says the change in profit here. We've got a change in profit. And we're going to look at the change in profit from a hedge. And so we're going to look at the change in profit on a per unit basis is due to a change in the spot price. Well, that's pretty obvious, and that's what we have when we don't hedge anything. We don't actually put on any futures. But when we put on a futures position, we have a change in the futures price, right? And that between these two, if they perfectly offset each other in a perfect hedge, then your change in your profit's going to be zero, because this is going to go up and this will go down by the exact amount. Okay? But now you got to keep in mind that we have cross hedges, and we may not have a hedge ratio. We may not be hedging 1 ounce to 1 ounce or 1 bushel to 1 bushel. So we're going to have a number of futures contracts in that we want to solve for. So what we're ultimately looking for here is we want to create an optimal cross hedge, taking into consideration that the futures and the spot prices don't move in sync, and that we may need more than 1-to-1 or less than 1-to-1 hedging. So what we need to do is we want to take this change in profit, and remember I told you hedging is all about trying to make that change in profit close to zero, because hedging is all about not making a profit but stabilizing your profit. So we want the change in profit from this to be close to zero. So here what we're going to do is we're going to look at the volatility of your profit over time. And one way to do that is calculate the variance of your change in profit over time. And that's going to equal, so the volatility of your change in profit is composed of these components, and then how these two components interact. How does the future price interact with the spot? Okay, so what that means is you're going to take the variance here of the change in the spot, plus you're going to have the variance of the change in the futures price. And when you look at the volatility and you calculate volatility, we're squaring terms here. And so we end up getting an n squared here. Okay? And now, this is basically assuming if these two were perfectly independent of each other, there'd be no correlation and interaction between the two of them. We'd be done with the formula. But obviously there's interaction and correlation between these two guys, which means there's covariance between them. So we need to take that into consideration. And so we need to, if you do the math out, and this math, by the way, the actual calculations come about and you'll see them in basic financial management and investment theory, portfolio theory. I'm going to cover it, but you don't need to know this derivation. So let me tell you, it should sound intuitive, but I'm not going to ask you to reproduce this. I'm going to ask you to know the bottom line results when I get to it, but not how I get to it, not mathematically how I get to it. But the reasoning should make sense. So we need to look at the interaction between these two, and that's where covariance comes in. And so we need to account for the n number of contracts, and we're going to multiply that by the covariance between the change in the spot times the change in F, which is the change in the futures contract. Now what we want to do is we want to find the optimal number of contracts to set this whole thing equal to zero. We want this to be zero because we don't want any change in our profits. If we have change in our profits, then we haven't hedged properly. So if you know anything, and again, you're not required to know this, if you've ever had a calculus course and you took first derivatives, that's what we're doing here. We're going to look at how does this means change. How does the change in your profit for a change in the number of futures contracts? Okay, we want this change to be zero because we want to find the optimal number of contracts. So that turns out to be 2n sigma squared, change in the futures, plus 2 covariance, change in the spot, change in the futures. And we're going to set that equal to 0. All I'm doing is taking first derivatives, set them to 0. Again, you don't need to know that, but when you get done with the math, you get n, and you got to be careful where we get. There's a negative sign that pops in here. Okay, so we get n sigma delta F equals the covariance of delta S or delta F. All I'm doing is I'm getting rid of these 2's because they cancel out, and I'm going to move 1 to the other side. So we have a negative sign here that we don't lose track of. It's easy to lose track of that negative sign. And we solve for n, right? We get covariance between the spot and the futures, right? Divided by the variance of the futures contract. Now, before we go any further, let's make sure we know exactly what covariance means. And I've shown you this before, but I want to make sure. Let me give you some exaggerated examples. if we have a spot price that moves like this, for example, and for some reason we find if we have a futures price and we put this is the long position, and we go short a futures price, we should be, it should be moving like this. The futures ought to be moving. Once we have a negative position, a short in the futures and the long in the spot, then when one goes up, the others should go down. And if you form a portfolio of the spot and the futures, look at that. The portfolio between the two, call it P, doesn't change because one perfectly offsets the other, and you have no volatility. And think of that as your change in profit, in a sense, from this situation. This is an example of correlation. Correlation equal to -1 when you have that short position in the futures. And so recall that correlation in statistics class goes from -1 to +1. If you have two assets that are perfectly positively correlated, then you have a correlation of 1. There's no benefits of diversification, right? Which I'll show you in a minute. But if you're at -1, you can get the maximum benefits of diversification, and the maximum benefits of diversification means that you've gotten rid of all risk, and that's what I'm showing you here. We've put on a position by taking a long spot and a short futures. They perfectly offset each other, combined with this negative correlation, which causes negative covariance. We have no risk. Okay? Now, if the two were independent, if the futures and the spot price were independent, then you'd have something wiggly and you wouldn't really have a connection to it. And it's really hard to draw something that's independent, but it's independent. There's no connection. They're unrelated, which means you got to seriously ask yourself, why am I hedging with something that's completely random and independent? It's kind of like hedging corn with platinum prices, using platinum futures. There's probably no connection between corn and platinum prices. Okay? But you want to find things that have perfect positive or negative, because then you can take the positions and use them to your advantage. Now, the thing is, when I'm figuring out call this N star here, because this is the optimal. This will be the optimal number of hedge of futures contracts that we want to do. Instead of 1-to-1, maybe it'll be 1.2-to-1, or maybe it'll be 0.8-to-1. It's this covariance term. So the covariance term, covariance in general, between, say, X and Y, let it be two stocks, two prices of anything, is the correlation between X and Y. And correlation is this italicized P. It's really called a rho. And it's times the variance of X times the variance of Y divided by the variance of Y there. So variance being sigma squared Y. Okay? And what happens is you can boil this down to, so this is the covariance right here, this part right here, make sure we're clear. This is the covariance term, and that's what's matching up. And then we have the variance here. And so this is technically the covariance term. And when you divide it by the variance of Y, it simply boils down to taking the correlation between the two and scaling it by the difference in the volatility of them. So what this does is, look, if X is substantially larger, that means that X is way more wiggly than Y. And then, so we need to have this scaling factor. This number will be much bigger than 1. And so we take this correlation coefficient and scale it and adjust it by this correlation. And so the important point is covariance takes into consideration correlation and the relative volatility between the two. That's why it's so important in finance, because it turns out that stocks and bonds, when you look at their covariance relative to the market in order to price them. And that's where beta comes in, if you recall anything about the beta of a stock or a stock index, which we'll touch upon in the next video. But for now, we want to capture how correlated the two series are, and we want to capture the relative volatility of the two. And so that's what we're going to capture here. Now, this turns out that this is what's called the hedge ratio. This formula right here is the hedge ratio. Call it HR. And what's also labeled as B, not to be confused with basis. There's no subscript here, so it's not basis, it's just B. And so this is what we're doing here. We're finding, we want to look at the change in the spot price, adjust and look at the change in the futures price, and adjust it for the fact that these two are not moving in sync with each other, and that we may have to have this hedge ratio that takes up the sloppiness between these two asset prices. Okay? And that's where HR equals the covariance between the spot and the futures relative to the variance of the change in the futures price. Okay, so this is change in S, change in F. Okay, it turns out that this is the same formula that's used in ordinary least squares in regression analysis that you had in statistics. So if you took a change in spot price and you had a whole data bank of changes in spot prices and it went down, and then you had a whole change in futures prices on a spreadsheet. And all the way down a column you had at the same points in time changes in spot, changes in futures. And then you need to take into consideration, well, you probably need an intercept there, because when you run a regression, change in F, change in S, the intercept is probably not going to go up or it's not going to go right off the origin here, which means this would be 0. It's going to probably look like this. You're going to have an A for an intercept, and you're going to have a B for a slope. So there's the B, that's not basis, it's B for the slope of this line, meaning that the spot and the futures don't move perfectly in sync. This would mean they move perfectly in sync, and that would mean 1 to 1. That would be a hedge ratio of 1 exactly, because the change in the futures equals exactly the change in the spot, and you'd be right through the origin here. Well, it's likely that they don't quite move in sync with each other, so the slope is not 1 to 1, and the intercept, which implies there's going to be an intercept. Or it could be that maybe the slope is higher, maybe the slope is, meaning it's steeper. It could be something like this. Again, we have a slope, which could be positive, positive or negative, or an intercept that could be positive or negative, but we have a slope that's greater than 1, the B, or a hedge ratio, okay, meaning the same thing, and is picking up that relationship. So the bottom line is we want to take into consideration this hedge ratio being the covariance divided by the variance of the futures. And that's what we're going to call N star futures. N star meaning, whoa, I'm losing you here. N star, N meaning the optimal number of contracts, and that's what the star means, optimal. And F means the optimal number of futures contracts. So the optimal number of contracts to put on a cross hedge boils down to this, and this is what you need to know. Is your hedge ratio times the size of the position being hedged in units, meaning bushels or pounds, okay, divided by the size of one futures contract. Okay, with the same units, obviously. So If you're doing corn to wheat, well, the contract size, or there's 5,000 bushels in each contract in corn or wheat, but the unit size is bushels, okay? Or in other cases, it could be pounds. And so that's the point that you want. This is the formula that you want to have to come up with the optimal number of contracts, because the optimal number of contracts is not necessarily 1. The hedge ratio should not be, the hedge ratio will not be 1, and so if this is not 1, then you're going to have a different number than you think for the optimal number of contracts. So if this was just 1 with a naive hedge, or if there was a perfect hedge, the whole thing washes out. You don't need it. And all you do is you look at the size of the position being hedged, your inventory, versus the size of a futures contract. And then it's relatively straightforward. But keep in mind that this hedge ratio reflects the covariance between the spot price and the futures price, adjusted for or scaled by the volatility of the futures price. Okay? Now, let's actually put this together, try to put this together with an example. Okay, so the example that we're going to look at brings together this idea of hedging, hedge ratios, and regression analysis briefly. So here's the example. The main ingredient to jet fuel is crude oil. Suppose that American Airlines wants to use light sweet crude oil futures contracts to hedge its jet fuel consumption. It runs a regression of jet fuel prices on the crude oil prices and obtains a B of 0.80. Okay, the T statistic is 3.56, and the R squared from the regression is 0.88. Now, I don't want to go deep into regression analysis. It's taking us too far astray, but the point of this is, at this point, the point is to say that when you run a regression and you want to see how does the spot, in which in this case is jet fuel, how do those prices correlate and match up with crude oil prices? They're not going to be one-on-one. Crude oil is, stuff that comes out of the ground. Now here we're looking at light sweet crude. Light sweet crude oil is light, meaning it's low in sulfur, meaning it's low in viscosity, meaning it's not thick and sludgy. So that's what the light part is. And the sweet part means it's not high in sulfur. Sweet means it's got low sulfur content. And when you got fairly liquidy oil that doesn't have a lot of sulfur, it turns out to be really good for making gasoline. Now, you might be able to make gasoline out of sludgy stuff, and you might be able to make it out of high sulfur, but it's more expensive to distill it and get rid of, to get rid of the thickness, and then it's also probably expensive to get rid of the sulfur. So people look for light sweet crude for making gasoline and other distillates like diesel. Now, it's also the underlying source to making jet fuel, but jet fuel is not the same as crude oil. They're two different, pathways through the economy, and there could easily be bottlenecks in one or the other at various times. So the prices are not going to move in sync. The supply and demand are not going to move in sync with each other. So therefore, we do have a cross hedge, and what this hedge ratio here is telling us that the two are not moving in sync. We're saying that the change in the spot for the change in the futures times the correlation between the change in the spot and the change in the futures is only 0.8. It's not 1-to-1. It's not 1. Okay? Now, I'm getting back to the ordinary least squares estimates here. You get a T statistic. Basically, the T statistic indicates, is this statistically different from 0? And the fact that it is, meaning you can see that it is, because remember, you need a T statistic greater than 2, typically. So here's average, here's 0, and here are 2 standard deviations to the negative, 2 standard deviations to the right, and you got 2.5% on this side of the normal distribution and 2.5% on this side. If your beta B falls into this area, you can't reject the fact that it's basically 0. Right? If you want to rely on this for hedging purposes, you need to be outside of these 2 standard deviations, and we're almost 4 standard deviations away, which is how to interpret that. So, oops, this should be a positive. And we're here like 3.56, somewhere out here, which means this is significantly different than 0. This number is statistically different than 0. Then the other number you want to look at is once you determine that slope coefficient, and that's what we're doing, we're looking at a slope coefficient that's statistically different than 0. And what we want to look at is at R squared. And remember what the R squared does is that tells you that 88% of the variation in the spot, in other words, crude, is driven by, jet fuel. Jet fuel is the spot. The change in jet fuel, 88% of that volatility is caused by a change in crude oil, which makes sense. 88% of the movement in jet fuel is caused by movements in crude oil. That's believable. That means 12% of volatility in jet fuel is caused by other things other than crude. It could be due to bottlenecks in jet fuel inventories, which could be associated with airline traffic and supply and demand in that particular industry. Okay. So let's keep this. What it's saying is we have a slope estimate of 0.8. It's statistically different to 0. It seems to explain a lot of the volatility in jet fuel. All this is signaling to us that we want to use this hedge ratio when we hedge. We want to use that. That's why we're calculating it. Okay, so now let's continue the story. It says, suppose that American wants to hedge an anticipated purchase of 420,000 gallons of jet fuel using crude oil futures. Recall what an anticipated purchase means, by the way. So when you have an anticipated purchase, you are exposed to risk on the upside. In other words, if the underlying is expected to go up in price, that's bad. Normally when you hold inventory and something goes up in price, you're happy because you hold it. But if you don't own it and you have to purchase it in the future, then this anticipatory hedge is like having a short position, because when you have a short position, when prices go up, you're kicking yourself because you're going to have to buy it back in the future at that higher price. And so the point is, an anticipated purchase is like having a short position in the underlying. So we anticipate the purchase. American Airlines anticipates purchasing 420,000 gallons of jet fuel in the future. Well, nearly every airline has that expectation. So now you can see the reason why they would want to hedge, because if you think about why would they even bother to hedge, well, they're booking their seats way in advance, and if they don't know exactly what the jet fuel prices will be when those flights take off, the costs could be significantly higher than what they booked all those seats for. And so what airlines do is they hedge those risks using futures contracts. The problem is there's not a big market for jet fuel contracts. They don't trade that much, which is why the cross hedge comes into play. Comes into play because crude oil is futures contracts. I hate to make the pun, but they're extremely liquid. There's lots of activity in those markets. So let me continue. You're basically short here is what I'm trying to say. So the size of the futures contract, each contract is 1,000 barrels of crude, which is equal to 42,000 gallons. Okay, so a contract, or each barrel of oil equals 42 gallons, and if you have 1,000 barrels in a contract, that means every futures contract controls 42,000 gallons of crude oil. Now, at the time the hedge is implemented, the spot price of jet fuel is $5 per gallon, and the futures price is $4 per gallon. Okay? So spot jet fuel is 5, futures price for crude is 4. How many crude oil futures contracts should American Airlines enter into to optimize its cross hedge between jet fuel prices and crude oil prices? Should American Airlines go long or short the futures contract? Well, we just said that American Airlines naturally has a short position in jet fuel because it's an anticipated purchase. Therefore, to hedge this position, the futures contracts need to be long. So that's the first answer. We need to go long the futures. And we know, let's go further, we need the optimal number of futures contracts, and that equals the hedge ratio that we calculate from regression times the size of the position being hedged divided by the size of a contract. Okay? And we said that the hedge ratio is 0.8. We have 420,000 gallons in our anticipated purchase that we need to hedge. Each contract is 42,000 gallons, and that means we need 8 contracts to hedge. We need to go long 8 contracts to offset our short, our implicit short position by having an anticipatory purchase. And notice now, here's how we can interpret this, and I've been waiting to try to come up with, to show you this, because now I can show you what this really means. First off, look at the fact that we have a hedge ratio that the two don't move 1 to 1. It's about a 0.8 ratio, which means instead of being 1, this is 0.8, and you don't need 10 contracts, which is the 42, which is 420,000 divided by 42,000. You don't need 10 contracts. You only need 8 contracts to optimize this hedge. 8 contracts. If you didn't optimize, you'd do a naive hedge, and you'd basically say, look, I need 10 contracts because I need to hedge 1 to 1. But the point of this is that they're not moving perfectly in sync. And if you consider the fact that they're not moving in sync, if you were to get 10 contracts, you'd be over hedging the situation. And there could be situations where you under hedge. If you want to get the right hedge, it's 8. The optimal hedge, which is hence that star here. Optimal number of futures contracts. Now let's continue the example. It says at expiration, the futures position of spot jet fuel is $5.25 per gallon. The crude oil futures price is $4.03 per gallon. Compute the profit or loss on the spot, the futures, and the total position since the hedge was implemented. Okay, so here we go. This formula. Spot minus the spot at the time of implementation minus the spot at expiration. This is when you have a short position, remember? This is this is the anticipatory hedge. Plus now you have the long futures. Oops. Where you take the futures at expiration minus the futures price when you implemented the hedge. Plug in the numbers. And so here you lost, right here, you lost 25 cents. And how do you interpret that? Well, if you didn't go into the market to hedge, if you didn't go into the futures market to hedge, right, when you put on the hedge, price of the jet fuel was $5. Now it's $5.25. You would lose 25 cents per gallon loss if you didn't take on the futures contracts. Okay? But now we took on futures contracts, so there should be an offset there. Okay, so let's plug in the gain or loss for the futures, and this is what happens. We end up getting 3 cent, oops, 03 here, 3 cent gain in the futures contracts that we went long. And so we lose 22 cents overall. which is better than losing 25. But notice the hedge wasn't, the hedge didn't offset that well. It only offset 3 cents. Why is that? Well, it's basis risk. We're dealing with a cross hedge. Jet fuel prices and crude oil prices don't move perfectly in sync. And when you have a cross hedge, you have a form of basis risk, a form of it. And so we can look at that, and we could say we can analyze this a little bit better, the situation. So we analyze the situation. We say, look, we lost 5 times 525. Oops, minus here. So we lost a quarter times 420,000 gallons, right? We lost 105,000 by having to buy jet fuel at 25 cents higher. We lose 105,000. We gain 3 cents times the 42,000 gallons per contract times 8 contracts. And that equals plus 10,080. So we gain 10,000. So overall, we lose 94,920. That's the crux of the situation. Okay, we lost the 94 mainly because we have a cross hedge problem. So another way to interpret it, these two numbers can't be equal when you have a cross hedge. You can't apply convergence theory because there's no way in heck jet fuel and crude oil will ever converge at expiration because they're not the same thing and the prices are quite different. They're different in this case by about $1 no matter what happens per gallon. So then so that kind of gives you a good flavor of the intuition here on why we should cross hedge, or why we should cross hedge. There's usually benefits, but this example is telling us, there might be some risks associated with it too. Part D says, asks the question, how would you answer change that the T statistics from the regression? What would happen if the T from the regression was 1.20 and R squared equaled 0.34? Well, drawing the normal distribution, we'd ask, is that significantly different than 0? And we have -2, we have +2 here, and here we're at positive 1.20. Well, if you're in this space, if you recall from the statistics, you can't conclude it's statistically different from 0. And that kind of means, well, you can't reject the fact that the slope is 0. There's no relationship between the change in the spot and the change in futures prices. You can't make, you just don't know. Not only that, it says that only 34% of the change in crude accounts for the change in jet fuel. In other words, 66% of the volatility in jet fuel is not being accounted for by crude oil, which means it's not another statistic that means it's not a good cross hedge. So in order to have a cross hedge that's good, you need to have an R squared that's reasonably high, close to 1, which is the maximum. And then you need T statistics that are absolute value greater than 2, so that you're out here in these tails, and you can reject the idea of a 0 relationship. I mean, think about it. If you have a 0 relationship for a slope, it's basically telling you you can't reject the idea that crude oil and jet fuel just don't relate to each other. They seem to be independent and statistically unrelated. If that's the case, it makes no sense to put on a hedge using futures contracts. It's like I said, it's, I use the example of corn and platinum. It's like using, jet fuel oil to hedge pork bellies, which is bacon in the agriculture market. Okay, so now I hope that is helpful. What I want to do is the next video we'll go into bond basics and the risks of bonds, which is measured in duration and modified duration. Get a handle on that. And then we'll go into hedging with bond futures contracts and stock index futures contracts and introduce the concept of target hedging in addition to that.